Hello everyone, and welcome back to our channel. Today, we have an exciting topic to discuss: investing for beginners. Investing can seem daunting, but with the right knowledge and a step-by-step approach, anyone can start their journey towards financial growth and security. So, let's dive right in. Number 1. Understand asset classes. Investments can be classified into different asset classes such as stocks, bonds, real estate, commodities, and even alternative investments like cryptocurrencies or precious metals. Each asset class carries its own unique characteristics, risk profile, and potential return. Stocks represent ownership in companies and offer the potential for capital appreciation and dividends. Bonds, on the other hand, are debt securities issued by governments or corporations and provide fixed interest payments over a specified period. Real estate investments can include residential or commercial properties, offering the potential for rental income and property value appreciation. Commodities such as gold, oil, or agricultural products can provide a hedge against inflation and offer opportunities for profit based on supply and demand dynamics. Alternative investments, like cryptocurrencies, have gained popularity in recent years, offering potential high returns but also higher volatility and risk. Understanding these asset classes is crucial because each one behaves differently in various market conditions. By diversifying your investments across multiple asset classes, you can reduce the risk of being overly exposed to one particular sector or asset type. As a beginner, take the time to research and educate yourself about each asset class, their historical performance, associated risks, and the factors that can influence their prices. This knowledge will empower you to make informed investment decisions based on your risk tolerance, financial goals, and time horizon. Remember, the key is to create a balanced portfolio that aligns with your objectives and helps you with market fluctuations. By understanding asset classes, you can better position yourself for long-term success in the world of investing. Number 2. Start small and diversify. When you're just beginning your investment journey, it's wise to start with small investments. This allows you to learn and gain experience without risking a significant portion of your capital. It's important to remember that investing is a journey, and you can gradually increase your investment amounts as you become more comfortable and confident. Diversification is another crucial aspect of successful investing. By spreading your investments across different asset classes, industries, and geographical regions, you can reduce the impact of any single investment's performance on your overall portfolio. Diversification helps to balance risk and potential reward. Within each asset class, diversify further by investing in a variety of securities. For example, in the stock market, consider investing in companies of different sizes, sectors, and regions. This approach helps to minimize the risk associated with a specific company or industry. By diversifying your portfolio, you can potentially offset losses from one investment with gains from another, helping to maintain overall stability. Keep in mind that while diversification does not guarantee profits or protect against losses, it can be an effective risk management strategy. As you gain more experience and knowledge, you can continue to refine and adjust your investment portfolio. Regularly review your portfolio's performance and consider rebalancing if necessary to ensure your asset allocation remains aligned with your goals and risk tolerance. Remember, starting small and diversifying your investments are crucial steps in your journey towards building long-term wealth. It allows you to manage risk effectively while taking advantage of potential growth opportunities. Number 3. Invest for the long term. One of the key principles of successful investing is to have a long-term mindset. Investing is not a get-rich-quick scheme. It's a journey that requires patience, discipline, and a focus on the long-term horizon. Let's illustrate the power of compounding with an example. Imagine you invest $1,000 and earn an average annual return of 8%. In the first year, you earned $80 in returns, bringing your total investment to $1,080. In the second year, you earned an 8% return on the $1,080, which amounts to $86.40. As this cycle continues over many years, your investment grows exponentially. The longer you stay invested, the greater the impact of compounding. It's like a snowball rolling downhill, gaining momentum as it grows. By starting early and giving your investments time to compound, you can potentially achieve substantial growth and build significant wealth. It's important to remember that investing involves market fluctuations. Prices will go up and down in the short term. However, by maintaining a long-term perspective, you can ride out these fluctuations and potentially benefit from market recoveries. Timing the market is incredibly challenging, even for experienced investors, and attempting to do so often leads to poor outcomes. Instead, focus on your long-term goals and remain invested, regardless of short-term market movements. History has shown that over the long term, the stock market and other investment vehicles tend to generate positive returns. By staying the course, you can potentially overcome temporary setbacks and take advantage of the growth potential offered by the market. So, embrace the power of time and compounding. Invest for the long term, remain patient, and let your investments work for you. Number 4. Implement dollar cost averaging. Dollar cost averaging is a powerful investment strategy that can help you navigate market volatility and build a disciplined approach to investing. With this strategy, you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. Here's how it works. Let's say you decide to invest $500 every month in a particular stock or investment fund. When prices are high, your $500 will buy fewer shares, and when prices are low, your $500 will buy more shares. Over time, this strategy helps to average out the price you pay for your investments. One of the significant advantages of dollar cost averaging is that it removes the need to time the market. Instead of trying to predict the perfect moment to invest, you invest consistently over the long term. By doing so, you mitigate the impact of short-term market fluctuations and focus on the overall trend of your investments. Additionally, dollar cost averaging allows you to take advantage of market downturns. When prices are low, you automatically buy more shares with your fixed investment amount. This strategy is often referred to as buying low since you acquire more shares at a lower price. As the market recovers, the value of your investment can potentially increase significantly. Another benefit of dollar cost averaging is that it encourages discipline and removes the emotional aspect of investing. Instead of making impulsive decisions based on market sentiment or short-term fluctuations, you stick to your predetermined investment plan. It's important to note that dollar cost averaging is a long-term strategy. It's not designed for quick profits or market timing. By consistently investing over an extended period, you give your investments time to grow and benefit from the potential long-term returns of the market. Implementing dollar cost averaging is relatively straightforward. Set up automatic investments, either through your employer's retirement plan or with a brokerage account. Determine the amount you're comfortable investing at regular intervals, such as monthly or quarterly, and let the strategy do the work for you. By implementing dollar cost averaging, you build a disciplined investing habit, potentially lower your average cost per share, and reduce the emotional stress often associated with market timing. It's a strategy that aligns with the principle of investing for the long term and can help you achieve your financial goals. Number 5. Use online investment tools. In today's digital age, online investment platforms and tools have revolutionized the way people invest. These platforms make investing more accessible, convenient, and user-friendly for beginners and experienced investors alike. When choosing an online investment platform, it's essential to conduct thorough research. Compare different platforms, evaluate their fees, features, and user experience. Look for platforms that offer a wide range of investment options, including stocks, bonds, mutual funds, and ETFs. One of the significant advantages of online investment platforms is the availability of educational resources. Many platforms provide extensive educational materials, tutorials, and even webinars to help you enhance your investment knowledge. Take advantage of these resources to deepen your understanding of investing and make informed decisions. Furthermore, online investment tools often include portfolio tracking and analysis features. These tools allow you to monitor the performance of your investments, track your portfolio's asset allocation, and assess your overall investment strategy. By having access to real-time data and analysis, you can make more informed decisions and stay on top of your investments. Online platforms also provide convenience and flexibility. You can easily manage your investments from the comfort of your home, track market trends, and execute trades with just a few clicks. This accessibility allows you to stay engaged with your investments and make timely adjustments if needed. However, it's crucial to be mindful of the fees associated with online investment platforms. Compare the transaction costs, account maintenance fees, and any other charges that may apply. Consider the impact of these fees on your investment returns, especially for smaller investment amounts. Remember, online investment tools are a means to support your investment journey, but they should not replace thorough research and due diligence. It's still important to understand the fundamentals of investing and make informed decisions based on your financial goals and risk tolerance. So, leverage the power of online investment platforms and tools to make investing more accessible and convenient. Research different platforms, compare fees and features, and choose one that suits your needs. Take advantage of the educational resources and portfolio tracking tools offered by these platforms to enhance your investment knowledge and stay on top of your investments. That's all for today's video on investing for beginners. I hope you found this step-by-step guide helpful. If you have any questions or topics you'd like us to cover in the future, please let us know in the comments below. Don't forget to like, share, and subscribe to our channel for more valuable content. Until next time, happy investing.